Imagine two people. Both start investing at the same time with the same amount of money. One follows the news, chases hot stocks, and trades based on gut feeling. The other reads one book and never stops thinking about it. 20 years later, one of them is wealthy. The other is still waiting for their next big win. The difference: one was a speculator. The other was an intelligent investor. In 1949, a Columbia University professor named Benjamin Graham published a book that would change the world of finance forever. It wasn't a get-rich-quick guide. It wasn't a system for beating the market in 30 days. It was something far more rare. A philosophy for building lasting wealth through discipline, patience, and rational thinking. The book is called The Intelligent Investor. Warren Buffett, arguably the greatest investor of all time, called it the best book about investing ever written. He read it at age 19 and said it changed his life completely. So what exactly is an intelligent investor? Graham defined it simply: an investor who is patient, disciplined, and eager to learn. Someone who controls their emotions, avoids irrational decisions, and thinks in decades, not days. Intelligence, in Graham's world, had nothing to do with IQ. It had everything to do with temperament. Number 1. They think like a business owner, not a gambler. When most people buy a stock, they see a price moving on a screen. An intelligent investor sees something different. They see a business. They ask, is this company profitable? Is it well managed? Does it have a competitive advantage? Would I want to own this business for the next 10 years? If the answer is yes and the price is right, they buy. If not, they wait. Number 2, they have a margin of safety. This is perhaps the most important concept in the entire book. Before making any investment, an intelligent investor asks, what if I'm wrong? They only buy when a stock is trading significantly below its intrinsic value, its true worth. That gap between price and value is called the margin of safety. It's a financial seatbelt. It protects them when markets crash, when companies disappoint, when the unexpected happens. And it always does. Number 3. They treat Mr. Market as a servant, not a master. Graham created a famous character called Mr. Market, an imaginary business partner who shows up every day offering to buy or sell his share of the business. Some days, Mr. Market is wildly optimistic and sets a very high price. Other days, he's terrified and sells cheap. A speculator follows Mr. Market's emotions. An intelligent investor uses them. When Mr. Market panics and prices crash, the intelligent investor buys more. When Mr. Market is euphoric and prices are sky high, they hold back or sell. The market is a tool, not a guide. Number 4. They never speculate, they invest. Graham drew a hard line between investing and speculation. An investment operation is one that, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Number 5. They are emotionally disciplined. Fear and greed are the twin destroyers of wealth. Intelligent investors know this, and they build systems to protect themselves from their own impulses. They don't sell during crashes. They don't buy during manias. They follow a strategy, and they stick to it. Graham described 2 kinds of intelligent investors. The first is the defensive investor. This person wants to protect their capital and earn a fair return without spending a lot of time managing their portfolio. Their strategy? Simple, diversified, consistent. Split between high-quality stocks and bonds. Invest regularly, regardless of what the market is doing. Rebalance once or twice a year, and never try to beat the market. Today, this often looks like low-cost index funds. Boring? Maybe, but remarkably effective over long periods. The second is the enterprising investor. This person is willing to put in the time and work to actively seek out undervalued opportunities. They read financial statements, research industries, study balance sheets, and look for companies the market has overlooked or unfairly punished. Graham called this value investing, buying dollars for 50 cents. It requires skill, patience, and a strong stomach. But done right, it can produce exceptional returns. Step 1. Build your financial foundation first. Before you invest a single dollar, Graham insisted you must have an emergency fund. 3 to 6 months of expenses. Be free of high-interest debt, and understand your risk tolerance, honestly. Investing is not a substitute for financial stability. It's built on top of it. Step 2. Know what you own. Never invest in something you don't understand. Before you invest, be able to explain clearly. What does this company do? How does it make money? Why is it worth owning? If you can't answer those questions, wait until you can. Step 3. Think long-term. Always. The intelligent investor doesn't think in months. They think in years, in decades. Time is the most powerful force in investing. It turns modest, consistent returns into extraordinary wealth. It turns crashes into buying opportunities. It turns patience into profit. Step 4. Buy low. Be greedy when others are fearful. When markets crash, and they will crash, most people panic and sell. The intelligent investor does the opposite. They see a sale. As Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Step 5. Keep costs low and stay consistent. Every dollar paid in fees is a dollar that won't compound for you. The intelligent investor minimizes costs and maximizes consistency. They invest regularly, automatically, and without emotion. Step 6. Never stop learning. Graham believed that the greatest investment you can make is in your own mind. Read, study, reflect. The intelligent investor is not a book you read once. It's a book you return to again and again, each time understanding something new. Here is the truth that most people miss about investing. It isn't about finding secret stocks. It isn't about predicting the next crash. It isn't about being smarter than everyone else. It's about being rational when the world is emotional. It's about being patient when everyone else is rushing. It's about thinking long-term in a world obsessed with right now. Benjamin Graham gave us a blueprint. Warren Buffett proved it works. And millions of investors who followed these principles have built lives of financial freedom, not by being lucky, but by being intelligent. The question is simple. Which investor will you be? If this video helped you, like and subscribe. And drop a comment below. What's the biggest investing lesson you've learned?